firm, Chris Capital, closing its 10th fund with a record of $2.2 billion dollars on the positive. Throughout the course of the day today, we are going to be diving deep on the various opportunities and challenges thrown by this very interesting year for each segment of the private company investing world. We will start with the LPGP interface panel, focusing on macro issues relating to the alternative asset class, followed by a venture capital panel with a special focus on deep tech investing. Post lunch, we will move to growth capital mid market segment and then graduate to the world of private equity. We will have plenty of time for interaction both during the panel discussion and the networking break in between. Between sessions, we will also be recognizing the best performing PEVC investors of 2025 via the APEX Awards. We now take the opportunity to thank our sponsors, Brand Capital, IDTA, Stakeboard Capital, Gaja Capital, TVS Capital, Ivy Cap Ventures, Pavestone Capital, and Chris Capital for making this event possible. We also thank our knowledge partners, AVA Insights, AZBN Partners, Kroll, Pioneer Legal, and Veris Law. We would also like to thank Probus Ventures for their support. With that, to set the stage for the panels to follow, let us start the day's proceedings with a presentation by Hari Krishnan, Strategic Advisor, Venture Intelligence, on what the data says on the state of private equity, venture capital in 2025. Over to you, Hari.
Thanks, Darshita. Good morning, all of you. I hope you have a good start to the event. I've been involved with venture intelligence for a little over 15 years, and just this morning, someone was asking around, this is which APEX event, right? Any guesses? This is the 5th, 10th, 12th. Any guesses? It's apparently the 19th. Right, so venture intelligence has seen the evolution of the PEVC industry for that many years, and we will have a look at the evolution of the industry through the lens of data. Just as a primer, what does venture intelligence do? The core of venture intelligence is a transactions database and financials database of unlisted companies, private companies, VC funded, PE funded companies. There is also an M&A deal database. All of these transactions are quite rich with valuation, EBITDA multiples, revenue multiples, and so on. There are directories of investors, companies, founders, LPs, etc. There are also publications, daily newsletters, weekly newsletters, quarterly roundup reports, specific theme-based sector reports, etc. as well. We'll look at the year 2025 as a roundup. And if you look at how the year went, yeah. Perfect. So you have about if you see the last 3 years, 23, 24, 25, it's pretty much stabilized at $33 billion overall, right? Of course, COVID year, there was a good spike. And the panel will talk about, what this means for the upcoming year as well, and what this signals as well in terms of this stabilization of the numbers. We look at a quarterly basis. While the first couple of quarters had a smaller dip, and then we see the last quarter of the calendar year coming back significantly, both in value and volume as well, with $9.9 billion invested in that quarter. Again, while there was a little bit of dip post-COVID in the number of unicorns, post the heydays of fundraise and rich valuations, things are coming back slowly and steadily. 24 and 25, almost equal number of unicorns in the fray. And on the venture intelligence portal, we have a very popular unicorn tracker. If you just go to the products and unicorn tracker, this is one of the most popular sort of go-to places on our website that's visited. that is very comprehensively covering all the unicorns and the details and how the evolution has happened. And as you see, we are 117 and counting. Feb 26 is the recent addition, NASA, which is a data center deal. So coming back to the data, if you look at the $100 million deals specifically, right? So that has also stabilized at about 70 per year. So we have 24, 25, 23 around that mark as well. Average check size is around the 30 million mark. That's also pretty stable. Looking at some of the top investments, so you have the Haldiram's deal was the biggest of last year, $1.6 billion. Then TPG's TCS data center deal was $1 billion, followed by bunch of BFSI deals, Sammaan Capital, IDFC Bank, again notably Babak Pinkas, there's a re-entry into IDFC, and Federal, PhonePe, and Jubilant. So no surprise here, BFSI still forms a core of the large bulge bracket deals that have been happening. In terms of industries, IT, ITES continues to dominate, and BFSI in the second place as we saw, followed by manufacturing, healthcare, energy, and so on and so forth. By stage, so you have early steady at about $2 billion, and growth. Again, post-COVID, COVID was a great year for growth investments, but it's again stabilizing at the $7-8 billion mark as well, with late stage increasing to $10 billion from $8 billion in the previous year as well. Buyouts, again, as you see here, it used to be $11 billion in 2024. In 2025, while it looks $7.6 billion, there is a shrink. But if you look at our database, again, sometimes we'll have to take some of these things in context. Again, I'll use this moment to show how in our database you can go quickly to the PE section, go filter for deal stage as buyout, and quickly look at the largest deal. So you already have in Feb 2026 a couple of large buyout deals. The NASA deal that we have just seen, which has turned a unicorn this year, and Chris Capital investing in Novartis as well. So in first 2 months, you have 2 large buyout deals already as well, right? So doesn't mean that there is a significant dip, but it's just that in the calendar year, it sort of fell into the early 2026 period as well. Before we go into fundraising, I thought I'll also give you a quick glimpse of what's happening in the AI world with respect to data, venture intelligence, etc. Right? So, as you know, we have a rich financials database that covers about 8 lakh companies for whom detailed financials of companies are available for about 60,000 and on demand for any of the 8 lakh companies. Quickly, we were looking at how AI can help all of us here understand the nuances and insights of some of these companies, right? So I was looking at one company without naming the company, which has turned profitable. The company has turned profitable, and I was looking at what the AI said. It said, while there is a turnaround, the PAT is derived from non-operating income, non-core income, other income, right? So, which is something that AI is telling, let's be watchful of the turnaround. Let's wait and watch if this is going to sustain over the next year, if the core operating income is also going to become profitable, right? And one of the other things which I also saw was quite interesting was, as someone who used to work in a fund and taking the projections very seriously and modeling out a projection, I was trying to take AI's help, and it did me the projections in just 2 minutes with all the base case, medium case, optimistic case, and the bear case, and fairly accurately. This is a company for which I've spent a lot of my time. I'm an investor in this company 10 years back and keep following it. I keep modeling on when do I time my exit, at what valuation, how is the next year going to be, etc. This is quite handy. So any of you who are users, feel free to check this out. If you have not used the product, feel free to contact our colleagues at the front desk who will be able to help you with that. Also on the funds, so I was looking at a fund, and one of the things, as a banker, typically you would want to know is what are the sectors of focus of this fund, etc. So there is a sector analysis AI tab here. When I clicked on that, it was showing me, what are the top sectors that they have invested in, B2B, tech, deep tech, number of companies in each of them, their investment thesis, and interestingly, their likely next themes as well, right? So which is very interesting for any banker or a next stage investor to look at as well. So with that, going back to our fundraise in terms of the kind of funds that are raised by the VC funds themselves. So this year, you had $11 billion raised, significantly up from the $7 billion raised in 2024, and more number of funds as well. So 79 funds did their fund closures in 2025. That's a good sign. Remember this number, so it's a little over $10 billion, $11 billion raised. We'll also compare it with the exit numbers that are happening. Again, as a subset of PE, the VC funds, so VC is roughly about 4.8 billion, a little under half, and 50 funds, the number of funds are much more than half as well. And these are some of the large funds that have been raised. Chris Capital, $2.2 billion. They did the first close 1.4 and final close at 800 last year, both last year itself. Motilal Oswal Alternatives at $800 million. Nexus, A91, Axel. Again, if you see, of the top 5, 3 are VC names in this as well, right? So that's a good thing to observe. So within VC as a category, so followed by Nexus, A91, and Axel. As you see, all of their fund sizes have become over $500 million now. Bessemer and Fireside follow it closely as well to make it in the top 5. Now let's look at the exits. So overall in 2025, you had about $21 billion of exits. Again, very steady, over $20 billion getting exited in the last 3 years. It's a good sign. And compared to the kind of funds that are getting raised, $10, $11 billion raised, and about $20+ billion, given back in exits. So shows the maturity of the Indian PE VC ecosystem in the last 15, 20 years. By deal type, so you have, public markets, which have become significantly promising in our part of the world, while, globally, US markets, it's still a lot more companies are choosing to stay private for longer. In India, it's very vibrant in terms of IPO markets, and that's been giving good liquidity. Again, we'll leave it to the panel to discuss on, how long is it a sustainable trend? Can that be a dependable source of exits and retail participation in the markets? Will that continue, and so on and so forth. Following the public market, we also have secondaries and strategic sale. Secondaries, while it shows a small dip, it's a tough one to track, because a lot of these secondaries are starting to happen today, not necessarily alongside a primary, right? Earlier, it's always only with a primary. Today, secondary funds and a lot of secondary deals are happening, which may not show up in the regulatory filings immediately, and hence some of these numbers, could be underreported as well. But this is the best that we could see. So in terms of large exits, so you have JB Chemicals exit by KKR to Torrent Pharma, $1.38 billion, which is the largest exit. You have a couple of IPOs, Vishal Mega Mart and Hexaware, and you have a couple of other Sayadri hospitals and Ayana Power as well. So Hexaware is a classic case. I mean, it was listed, delisted, and then relisted. So it's a very interesting case of exit as well. So again, we were talking about the PE-backed IPOs. So as you see, over the last 2 years, it's been $8 billion worth of exits, coming on back of $3 billion in 22 and 23. So significant ramp up in that, and would love for the panel to discuss the way forward on this as well, and also give some ideas on where the growth stage companies that are preparing for IPOs, how can they prepare well, what are the things to watch out for. I'm sure many of the funds here you have some of your portfolio companies that have gone public and learnings from there in that preparation process as well. So these are some of the P-backed IPOs that have happened in 2025. Hexaware, as we spoke, and Lenskart, Grow, Meesho, all of these from the tech startup world that have gone public and gathered a good amount of interest as well, and NSDL as well there. So that's pretty much it, roundup on data from Venture Intelligence. Hope you guys have a great day, good networking session as well, and look forward to being in touch through the day. Thank you.
Thank you so much, Hari. That was really informative. Requesting the people sitting on my left-hand side to please take the seats forward to have a better understanding of the screen there. Thank you so much. We will now get started with the inaugural panel titled The LP-GP Interface. We welcome on the stage the speakers on the inaugural panel, including Ankit Tandon, partner AZB and Partners, who is a moderator today, Ajit Kumar, managing partner, Evolvence India, Dominic Go, Managing Director, Harbour West Partners, Vikram Gupta, Founder and Managing Partner, IBCAP Ventures, Krishna Ramachandran, Managing Partner, TVS Capital Funds. I request all of you to please take the stage. I now take the pleasure in introducing the moderator for the panel, Ankit Tandon, partner AZB and Partners. Ankit Tandon has over 15 years of experience and specializes in corporate, M&A, private equity and white-collar crime-related matters. He regularly advises listed and unlisted entities across different sectors on fundraising, acquisition disinvestments, business transfer arrangements, joint venture arrangements, and general corporate related matters. Additionally, Ankit also handles AZB's white-collar crime and compliance and investigation mandates and has conducted investigations on behalf of several clients on accounting, financial impropriety, vendor onboarding, etc. Over to you, Ankit, and the panel.
Okay, thank you everybody. Thank you panelists for being here. I think the topic today is LP-GP interface, and I think we will be primarily discussing three aspects. So the first one would be the general LP trends. How do we look at the India PE, VC, the general trend in terms of context, what is the IPO momentum, which was just talked about a short while ago, and what more can the government do to promote this sector. So perhaps I think we'll just start off with the general geopolitical and trade-related uncertainty. So maybe Dominic, for you and Ajit, we've had the recent announcements of the EU trade deal as well as the US trade deal. We've, of course, also had the US Supreme Court judgment against the tariffs which have been imposed. So considering all of this, as well as the general trade wars which are actually happening, when you look at India from a competitive lens and a comparison with other jurisdictions, what are the opportunities as well as what are the risks which you factor in when you are looking at India from an investment point of view? Perhaps, Ajit, for you?
Yes, of course. Good morning, everyone. Uncertainty and tariff, there is a old saying by, President Roosevelt, the fear is fear itself. Fear is fear itself. Something very similar to that, there's another saying called uncertainty in uncertainty, which is relating to quantum mechanics and probabilities, statistical probability, etc. But the uncertainty around the tariff, even after the Scottish ruling, is continuing. You see, if you look at first it was 25%, then to 50%, then we had a proposed trade deal which came down to 18%. Correct. Then the SCOTUS ruling 10%, 15%. But as of now, I mean, I haven't looked at whether something has changed.
I think 50.
Yeah, so as of now, we are at 18.5%.
That's correct.
Because the 10 plus, 5 plus, there's a 3.5% old MFN related tariff. So we are at 18.5, which is not bad when you consider the proposed 18% tariff actually. However, the uncertainty is this 15% is, as per the presidential power as of now, is only for 150 days.
That's correct.
So what happens after 150 days? Whether the president will seek a congressional approval to regularize it, or after 150 days this will go off. We don't know what is going to be happening actually. So there is still uncertainty, and that uncertainty continuing. But when it comes to geopolitical uncertainties, which you alluded to, because I don't think the world over the last 30, 40 years have been so uncertain, geopolitically, and every day something or the other is happening. When particularly for India, my view is that this is, the uncertainty between the US and India is some kind of intended strategic ambiguity, which is leading to tactical uncertainties. And that is likely to continue. The reason is because we are a growing economy, a growing military power, and so these kind of, uncertainties are built to create issues or get deals done. So that will continue actually, irrespective of which dispensation is in the White House. But the good thing is that both are democracies, and we will find a way to navigate these changing and challenging times actually. And I think I'll stop there, and then I'll ask Dominic to continue. Pick it up from there.
I think a lot has been said on the topic. Look, as a global investor ourselves, right, we're not just limited to India. And helpfully or maybe unhelpfully, right, the tariffs are being levied on everyone. Everyone's impacted, right? The US themselves are also impacted on the other side of the trade. And so, for us, the relative question actually is moot, because everyone's going to get a first order impact, a second order impact. There's no way of trying to figure all of that out. I think the other point to make as well is being global ourselves, again, there's an element of diversification that we think about. And I think there is also then, in that sort of diversification, we also, as a general rule of thumb, like to go after or get exposure to what we call quality GPs and quality companies. So whenever you go through a period of dislocation, uncertainty, volatility like this, and I'm sure more of it will come, again, being invested with the best managers that you can find, the best companies, to take advantage of all of the uncertainty. So it's the same ethos that we've had, over the past few decades. Don't see it changing anytime. Don't see it being any different this time around. And it's something that has served as well. I think the other point to make also is private equity, as opposed to public equity, is a very long-dated game, right? And because of these ups and downs that happen when you open a newspaper every morning or Bloomberg. Private equity managers don't quite have to react in that fashion, unlike public market investors. And so, we tend to take a much more longer-term view of the events that are unfolding in front of us.
Oh, thank you both. I think I had a follow-on question. This is more.
Can I add something?
Please.
I might sound like I'm speaking for the BJP, but if I was to say the three things that have happened positively thanks to Trump, one is our free trade agreements with other countries like EU, which has been going on for 2 decades, have seen closure. So it's been a very positive. We are forgetting what Trump has helped us, right? He's helped us sign these free trade agreements with our regional partners and elsewhere, right? One. Second, our own exporters are now exploring other markets. They took US for granted. 80% of supplies are going to the US. Now they're saying, let's look at Europe, let's look at Africa, let's look at elsewhere. So our exporters are diversified. Third thing, many of us know, I think between the Prime Minister, FM and RBI and others, they have dashboarded the ease of doing business. Sure. So significant relaxation happening in India, so our own ability to do business is better. Consequence of that for our industry is there are more opportunities. Manufacturing was not the very hot place for us to invest. Suddenly, in the last 2 years, it seems to have become very hot because there are a lot of opportunities coming in, and Indian companies exporting all sorts of stuff, right? Not just defense aero. So that, especially defense and aero and space seems to be a big opportunity. So I'm seeing it as a positive, what Trump is doing to us as an economy and as well as to the PE industry. Because new opportunities are coming up. So
No, I think that
let
was
him keep rocking this way every day morning. Something new will happen for us in India.
That was exactly my follow-on question, that generally the trend in India has always been that when we are pushed against to the wall is when we will actually reform. So we've now had our labor codes which have actually been reformed. So that's again, not necessarily because of the tariffs, but it is a positive step. I think farm laws is again something which perhaps is also in the pipeline. There have been political issues as well. So yeah, I agree with you completely. It's there. I think the only follow-on question I perhaps had was, do you guys, when you're valuing a company, also to some extent place some discounts from a risk factor perspective? Typically, let's say for companies which are primarily export oriented, I mean, given this uncertainty, how does one kind of value them? I mean, is there a so-called rule of thumb of a discount which you will build in terms of valuation, or given that most of the private credit is for the long term, it evolves over a time and there is not necessarily a discounting which needs to be factored in? Perhaps anybody in the panel can take that.
I can start with, you know, I'm giving you an analogy, but when investors ask, especially outside, do you hedge your rupee?
Correct.
Because for them, it's a dollar-related returns. So we tell them, look, you know, in our underwriting model, we provide 2.5 to 3%, you know, against diminution of the currency. So then if they ask, why 2.5 and 3, why not 3 or 2.5? I tell them, look, you know, we invest into companies also which has got dollar revenue. So if the company doesn't have dollar revenue, we take 3%. If the company has got dollar revenue, we take 2.5% basically. Something very similar to that, you know, what happens is these tariff-related uncertainties are not certain as of now. See, so underwriting that can work either way. It can create problems actually. However, I think the you know, uncertainty around that can be built into your modeling, possibly building some cushion, but it's not going to significantly change the valuation model or you know, your overall return expectation, etc. Because if it was 50%, so then export-driven companies obviously you need to provide for. But I think we are out of that. So because of that, I think, you know, it doesn't matter much now. In fact, after the Scotter ruling, India is now possibly in a better situation than what it has been earlier. Earlier, even you know, even after the proposed change to the tariff or the bilateral agreement, bilateral trade. So I think that doesn't matter much. But then, you know, managers who are looking at more conservative approach to their evaluation, possibly they could provide something. And so this could be, you know, there is no thumb rule as such, but firms can have their own way of looking at it and taking a call and provide something. That is how it is.
Anybody else would like to add?
Yeah, so I think broadly it depends on the nature of the business. And what we've also seen an indirect impact. You know, so we have a company called Bluestone in our portfolio, which went IPO last year. And while they sell their entire jewelry in India, everything happens in India, manufacturing in India, selling in India. But jewelry exports as a sector to the US got impacted by the tariffs. Now, what would be the indirect impact of that is like if lesser export of jewelry is going to happen, that means a lot more, those jewelry which was going to the US is now going to be sold. So there's going to be more supply. So I think that has an indirect impact on a business like that. Similarly, we have a company called Agraga, which is a cross-border logistics. So 60% of their logistics was happening to the US markets earlier. And like what Krishna was saying, basically this has actually helped open up trades with other countries. Now we've seen the impact of that. now that 60% has actually come down to 40%. Their revenues have actually grown because the trades with other countries have increased. So effectively, it's actually an opportunity for the Indian companies which are getting impacted. They are able to see opportunities elsewhere, which otherwise might have been on their blind spots earlier. And now they're seeing, I'm now seeing a lot of UK government initiatives happening in India. In the last week itself, we've seen some UK government, some mayors coming from their cities now talking about the free trade agreement value, or how can that actually increase the trade between the countries. A lot more new avenues of trade are opening up. And that's not just with UK, but with other geographies. People are now looking for those markets and even looking to create new products for those markets. You know, earlier, you know, people used to just only think about US being the largest market. And I think that mindset has changed quite substantially. And therefore, from the impact on the businesses and the valuation that you ask, and I think we typically look at a 5 to 7 year time frame. And for us, when you're looking at today, I mean, the uncertainty, as Ajit was saying, is like changing every day. But I think at the same time, you also look at the intention of these changes which are happening. So very clearly, the intentions are they want to move the manufacturing to the US. They want to move the jobs within the US. They want to move all the external people as much as possible not coming to the US. So if that's the long-term view, then I think anything that can get impacted because of that. I think the positive side is that a lot of Indians are now coming back, setting up startups here. So new startups are getting created. That's why we have now suddenly the curve of the number of startups happening in India is actually now increasing substantially. A lot of capital because of that is getting created domestically. We've seen government RDI fund about $11 billion and a lot of other pockets of capital getting created. And I think I see this as a huge positive thing for India. And where we are sitting as VCs, we see that as a value from a longer term perspective, 5 to 7 years perspective. We see that as a huge value over that period of time.
Thank you very much. I think just to follow up, please.
Sorry for barging in.
No, absolutely.
I think there's someone here from Crawl, he can answer better. There are actually valuation guidelines.
That's correct.
Valuation. So bulk of the valuation, as you know, in mark to market, just its basis done on comparable company basis.
That's correct.
Or recent transaction. Bulk of these are two.
That's correct.
Broad methodology, right, which you do. So in that, if you see, you already have a reference factor of what's happening in the industry and comparable. So the discounting will happen or the uptick will happen accordingly. So I think therefore, I don't think any of the funds will be carrying unrealistic valuation
expectations
at this point of time, because if they're following the IPV guidelines, which is mandated by SEBI. So therefore, that's a big tick. The second positive thing is we are patient, right? Patient capital. So these are all trends of, like you said, 5-7 years. These are all passing. As long as you eyes on the exit and you're holding it as something that you believe the exit valuation be correct. So I think I can speak for my fund. I'm sure you can speak for yours. All of us collectively, I think the funds will hold it true, based on the guideline, which is independently also reviewed, and the valuation should be held. So nobody should be concerned whether we are holding valuation at last year's value despite all the fluctuations, right? So
no, thank you very much. I think my follow-on question, not precisely on the geopolitical, is more for you, Vikram and Krishna. You guys are primarily looking at domestic rupee capital. How has your experience been interacting with family offices, Indian institutions, as well as HNIs? How have you seen the growth happen over a period of time to where we are? I mean, it has evolved. Perhaps you can start off what was in the nascent stage and what we are now, and what do you expect to happen in the future, purely from a domestic fundraising point of view as well?
Yeah, I think when I started IVCAP 2011-12, there were just about 7-8 funds in India at that time. Venture capital was a new term in that sense, even though there were a few venture capital funds. Startups was a bad word, actually. In fact, if you were raising capital from Indian institutions, and which is almost 80% of our capital, we were coached not to use the word startup because people would assume that the money never comes back. Things changed quite substantially 2016 onwards, when this startup word became a buzzword. This entire Startup India movement started. And from that time onwards, the number of startups have grown exponentially, right? So we've seen over 200,000 DPIIT registered startups now. And another very interesting thing happened before 2021. The 2021 was a defining year for the country, because that year saw the maximum number of unicorns in a single year, about 41 unicorns. And the IPOs of loss-making companies happened for the first time, where people could never assume that loss-making companies could do IPOs. And these were all startups earlier, and they became unicorns, and then IPOs happened, and it started a new trend. And before that, if you actually go and try to raise capital, one of the fundamental questions was, where's the exits? How are you going to get your money back? So the exits was a big challenge. And I think post 2021, and I think we saw some very interesting data
That's
here,
correct.
and almost $75 billion was raised over 375 IPOs. I think that's an amazing kind of evolution of the exits that have happened for the PEVC over time. And we've seen a lot of M&A, and a lot of M&A by Indian companies. Actually, if you see, so we sold companies to Reliance, to National Stock Exchange, to Birlas, to even foreign investors like Dentsu. So a lot of that M&A happened, and that also built in a lot of confidence among the investors. So what we saw, the segments of investors, institutional investors on one side, again, three different pockets. We have banks, insurance companies, and the government. And the government also across two different pockets. There's a central government with different departments. We've seen SRI, we've seen Technology Development Board through DST, and then we've seen state governments. We've seen state governments like Odisha government, Kerala government, and now we are seeing Rajasthan government, Tamil Nadu government actually coming up with their own pockets of capital, Karnataka government. So all these have happened, and the Indian government pocket of capital is basically coming with the intention to promote this entire startup ecosystem. And of course, given the fact that now, of course, we saw last week at AI Summit, the boom that is happening from the technology perspective. And I think there is a huge, basically expectation from the market in terms of the kind of value which will get created and the investments which are going to happen in the entire 5 layers of AI that we talk about. And I think given that while we've come from 0 unicorns to 126 unicorns, I think there's expectation of another 500 unicorns over the next 10 years. If that is the trend we are seeing and the economy doubling in that time frame, imagine the kind of impact that we can make, and therefore the pockets of capital getting more excited with family offices now putting in their money not only in funds, but also wanting to take direct bets, and therefore using funds to do co-investments. So that's another, and that class of investors or LPs has actually grown quite substantially. And on the other side, we now see also angel investors also become investors in funds, who writing smaller checks, but that's again a very large pocket of funds coming in. So I think very exciting times from the perspective of VCs like us.
2 data points I would like to give.
Sure.
I think one, in the last 10 years, the number of income tax filers for more than 1 crore has become 6 times, from like something like 50 lakhs to 3.2 crores. So that's one data point, right? The second data point, which we'll all be proud of, between 24 and 25, now 55% of the capital committed to VCP is domestic capital. So actually we have crossed, earlier it was skewed towards foreign capital, and we are making somebody else rich outside India for the money that was being generated here in some way. Sorry for saying this, but now 55% of the capital is domestic. So that's I think 2 very clear data points which indicates that there is significant interest in its going. And from the government point of view, I think the lot of work that you have done with the PFRDA, which is unlocking the pension fund that you and IBC and Gopal have done, is amazing. There's a huge amount of money that will flow in from the institutions into here, which is there. And therefore, maybe, Arun, it's a point of time to stop showing it in dollars and show it in rupees, right? So to make it more realistic, because it's not volatile, it is more stable in some way. Yeah.
Thank you. Thank you for that.
Can I add some?
Yeah, please.
No, I was just going to make
Please,
the,
go ahead, Dominic.
the point to say that I think the importance of having domestic capital become or speak for a larger part of a country's capital market is an important one. I think we've seen it in India on the public side happening, and what that has brought, right, to the country, right, stability of more stable, less volatile markets, et cetera, you know, the same should happen on the private side, right? And which is what we're seeing. And we've seen this in other countries as well. China is another example, and so on and so forth, right? So it can only be a good thing when the you know, when it's local capital that understands the risks and rewards of investing in their own countries better than, you know, a foreign investor can. And that should be the case. And I think for the longer run, for the longer, you know, the health of just the ecosystem in general, that should be the way. So, you know, it's really exciting to hear about these changes that are happening with the pension, you know, the local pension regulations and so on and so forth. So, you know, pretty exciting times, I think, for the ecosystem.
Maybe to add to all the three of them. You see, when we started way back in 2004, we are currently into Fund 5, and we are one among 7 funds in India into Fund 5. So those days, it was been very, very difficult to even find a manager with Fund 2 history, actually. And in our, you know, so we invested with many of the Fund 2, mostly sponsored by institutions those days, and it all changed for obvious reasons. So at that time, there has been, you know, some retail capital raised by some of the managers. The intermediaries charge about 5 to 6% on that. Private equity charging 5 to 6% upfront is, you know, I don't know what word to use there, but and the vintage has been so bad with the European sovereign debt crisis to global financial crisis to UPA2 issues to currency. You know, in our Fund 1, you know, I was looking at the numbers, the exchange rate has been 39.9 to the dollar. So with all that, investors load substantial amount of money, not only outside, but those small domestic investors. So the Indian investors, you know, the Indians are generally, by and large, have got that, you know, calculator risk-taking abilities and capacity. So they started investing even in 2004 onwards into private opportunities. However, the bad vintage of those days have pulled them back, actually. They didn't come to the market again until 2008, 9, 10, the venture started emerging, actually. And people started seeing outsized returns are coming from venture, and the overall ecosystem where government has started as an enabler to the whole startup ecosystem in various ways. And also when families, especially people who have got disposable income from their operating businesses, started this as an opportunity to invest, and because then they don't have to struggle, with their own, operating businesses, to that extent, or continue to deploy some capital to very non-correlated areas, actually. And also the second, third generation of those, people educated outside, and they see how family offices are working in the US or in Europe, for that matter, and generating comfortable return year after year. So because of the venture revolution in India and the understanding of how private market investments are helping family offices outside India, I think started bringing in more and more capital to the venture industry, basically. So if you look at the family capital allocation, it's much more into venture than private equity. Because again, that risk-taking, what people are expecting possibly outsized return over there, and which is happening, I believe. So it's going to attract more and more capital, and I would say that Indian ecosystem for family offices are still at a very, very nascent stage. Sure. Yesterday I was talking to a family, which we invested in the past, but they never had any investing idea local other than the public market. But yesterday he was telling me, I put together a family office, I appointed a CIO. So you see the changes on the ground. And when you try to raise capital as well, for the first time, we are raising a domestic tranche together with our Fund 5. We are raising capital outside for Fund 5. First time we put together a vehicle, we got the CB approval. So when I'm talking to investors, I see the changes on the ground. And I'm also surprised to see some of the sophistication of these family offices, though we are at a nascent stage. there's a long way to go, but some of the people involved with the family office investments are very, very, at par with outside investors. Maybe they got educated outside or they got experience from various people, but it's slowly, slowly picking up. And the domestic LPs is going to be a force to reckon with for all the managers who are going to raise capital in India.
No, I think, thank you. I think that the follow-on point would be, I think, I wasn't aware of the fact that 55% of capital is now coming from domestic. So I think that is a great fact to happen. I think then the follow-on point would be in terms of exit opportunities for all of these guys. We certainly have the IPO market, which is booming and buzzing for now. But bearing that, what has your experience been in the non-IPO market? And I will have a few questions on the IPO market a little later. But what I wanted to get a sense from you is how have you generally been looking at exits for companies which may not have an IPO? Whether it is a direct secondary level exit or is it more a fund level exit? What's the general experience? If you can't take names, that's perfectly fine. But the idea was just so that the audience can get a little bit of perspective of what is working and what isn't. Perhaps, Vikram, you could start.
Yeah, so I think, of course, Dominic would have much longer experience in terms of the secondaries, but I think the secondaries itself is actually emerging as a big sector in India. Yeah. I still remember until our Fund 2, SIDBI used to have a clause that you cannot buy secondaries. Which means, SIDBI is one of the largest domestic investor in funds, right? Yeah. They've invested in 150 funds or so. And they used to say that the capital can only go as primary. And that was the mindset that, basically you have to only invest in growth. I think they've also realized that, and now they've changed that clause. So basically, they know that you need only if you create secondary market. And now they're in fact encouraging secondary funds. They're actually looking to invest in secondary funds. So you're actually seeing evolution of secondary funds happening in India. Now, I think from a fund perspective, when we reach a point where we will have to take a call, whether we, eventually you'll have to give exit to your investor within the time frame. So you have two options. You basically, or three options. You actually sell your assets, underlying assets. You do an M&A or you do an IPO of those assets or do a secondary on those assets. Or you sell your stake at the fund level to Dominic or to somebody who actually is willing to buy at the fund level, the units of your LPs. Yes. Or you create a continuation vehicle which you offer to your existing LPs and new LPs who would be willing to buy this set of assets. You can actually take out the specific assets which you believe you want to hold for another 5 years, and therefore you then take it to your investor and say, hey, this time frame is over. So that's the third option. So I think all these options have now been tested very well in India. And we've seen multiple instances of these now happening. So people know, the valuation benchmarks have been established. The discount rates have been now, they have experienced these kind of discount rates. So people now know what kind of discount rates you're looking at. And therefore the valuation benchmarks and how you're valuing your companies also. There's some standardization building up there as well. So in that sense, I think the market has evolved to a point where people now know that you will get an exit, basically. So effectively, that's the reason, one of the biggest question mark was, will I get my money back? And I think even for us, like we did one of our biggest exits happened through secondaries, actually. So in Purple, we had invested 15 crores and we got a 330 crore exit in that company, all by secondary exit. So we actually sold it to Sequoia and World Invest. And at that time, that secondary market was not known for giving those kind of exits. So I think that has also evolved. So I think we are now seeing all kinds of models emerging there, and therefore the confidence in this asset class has substantially increased.
Please go ahead.
I think I've just found out the reason why in my first trips to India 10, 12 years ago, nobody responded to my email because the word secondary was on the in my sign off in my email header, and that it was a bad word in the industry. Look, I think all of that what you said about secondaries, I think that's exactly how we generally see private equity ecosystems evolve. First being of very primary led, and then secondaries come in because the IPO market isn't able to provide the level of liquidity that funds require within that time frame, et cetera, et cetera. What I'll add to that is, I think, in addition to the proliferation of, I think, the secondaries and the evolution of the secondary technology. So 5 years ago, the idea of a continuation fund was pretty much unheard of, right? That was an evolution of previously what we would call fund restructurings, et cetera, et cetera. So the technology has also shifted, but I think in India, what has also happened is the GPs in India have become a lot more conversant and understanding and accepting of using secondaries. And I think that is a one big change that is happening over time. And look, part of it is also, they see in the ecosystem that this has worked, these types of transactions have worked. LPs are happy with it. And then I think the other part of the reason is that, to the point as well, funds expire and sometimes not by choice.
Yes.
They do need to find a solution. So when you kind of put all of that together, the other interesting point about the India system as well is private equity here, unlike maybe some of the other Asian markets, has gone through cycles. Right, I think India is probably, you would say, 1, 2, 3, third or fourth cycle now. So there's been ups and downs.
That's correct.
And there's been attrition in the general partner community, but the GPs that are today operating and raising funds, they understand how important it is to deliver DPI to LPs on time, right? And I think consequent to that, I think being able to then see the benefits. There are risks and benefits of using secondaries, I think is the important thing. And so I think as a global investor ourselves, but even within the Asia Pacific region, which is where I look after, I would say that India has been and continues to be quite a big part of our deployment across the region for precisely this reason. It's because the GP market is actually a lot more, I would say, mature and understanding about the technology and how to go about using it.
Krishna, I like your inputs as well. Primarily because you're dealing with family offices, domestic capital. How are they comfortable? Are they looking at IPOs only at exits, or you have had similar experiences where people are looking at secondaries, continuation funds? I do suspect family offices generally may be having a longer term horizon, and perhaps, as I think rightly pointed out even earlier, may have good risk-taking capacity. So what's generally your experience been?
If I go back in history, out of the 27 exits we did, 14 were IPO. And largely because the way the taxation was, right? 10% for listed versus 20% in surcharge for unlisted, which thanks to FM's foresight last year has made it 12.5% across.
That's correct.
So therefore now I think the opportunity for secondaries, the opportunity for other strategic exits have become attractive, because at the end of the day, while we say we give X% IRR, the family offices look at it post-tax, right?
Correct.
Institutions not so much, because they have an overall tax pool, they look at it. Family offices clearly look at this post-tax. So I think from their point of view now, I think secondaries are attractive. Where I think I should carefully tread into the area. I think family office is also interested in buying off secondaries from the funds, because they have a slightly more long-term view than we could have. We are regulated for a fixed term, like as you mentioned, of the fund life. So I can give 2, 3 public examples, right? We exited Nika, MedPlus, and I think NSC at different, prior to my joining. We could have made multiples of multiples if we had held on to it. But because of fund life, we have to exit, right? We had to exit at that point of time. So the family offices have always been interested in picking it up from us. But the regulation today in terms of conflict of interest for well-governed companies becomes a bit of a challenge. So the continuation fund is a good regulation of the government. I think secondaries growth is very important, I think. But the family offices are most happy, if they get long-term returns, because they're actually investing money for multi-generational, right? Like I think Ajit mentioned, Some of the family offices size are significantly larger than the funds.
That's correct.
Their teams are also larger than us.
That's correct.
They're hiring managing director level of people from investment banks and institutions to run their family offices. They're running it as professional as anybody else. So from their point of view, I think they're looking at return, and they're also looking at opportunity they can hold it longer. Right? Like I've had conversations where they said, can you not give me the DPI in cash, but can you transfer the share? You know, so these are all interesting things the regulators should hear, because these are asks. You know, end of the day, the person's putting the money, he's taking the risk. If he's out to ask, I think we should listen to them and make those tweaks which is there. So
Very well.
May I add something?
Please,
on
please, please.
To the point of Dominic's evolution of secondaries in India, you see, secondaries started way back in 1979 in the US actually, as a liquidity mechanism, plain vanilla secondaries. Ever since that evolved into, now we have got various, you know, mechanisms of, one is obviously continuation vehicle, then you have GP-led, LP-led, then you have interval funds where you get periodic liquidity, then obviously you have the perpetual vehicle, but interval fund is an interesting asset class which is gathering a whole lot of asset actually. So all this has evolved over the years. And when it comes to India as an exit mechanism for secondaries, you know, we are hearing a lot of noise, but transactions are far and few. There are a few reasons to it. One, always the gap between the bid and ask. It's a challenge. And two, like, you know, a few years back, one of the large secondary fund operators wanted to say our minimum ticket size is $50 million. You see, if you look at secondary opportunities, what happens is you have to see where that secondary is going to come from. Our fund size, you know, 4, 5, 6, 7 years back has been, you know, 100 million, 150 million, 200 million. You know, so the secondary opportunity or the deal flow available is very, very small. You may be reading in the newspaper, or you would have heard, okay, this particular pension fund in the US liquidating $800 million of secondary for liquidity or portfolio optimization. We have not reached there yet. Possibly another, you know, our overall private equity investment in India is about $40 to $50 billion per annum. That is, you know, to the, you know, if you compare it with PE investment, PEVC investment to the GDP, it's about 1.25 to 1.5%. Whereas in the US, it's about 6.5 to 7% on a $30 trillion economy, which is close to 2 trillion actually. You know, so we are on a different level, but as we grow and more money get deployed, because without a strong primary pipeline, there cannot be a secondary pipeline basically. It has to flow from there. So I think, you know, we are evolving, but secondary activities are slowly picking up. And currently, when it comes to IPO and exit, so our main route of exit is now IPO. Obviously, India is possibly the largest active IPO market in the world today. Last year itself, about 280 of them. And so what happens is IPOs will continue. The reason is we have a less onerous listing regime, and the compliance cost is not as high as in the Western world. So, and, you know, not only providing liquidity to investors as well as liquidity for themselves by the founders or promoters. You know, in India, like taking the company to the board itself is a, you know, it feels to be a, very, very, you know, proud moment for the founders basically. So IPOs will continue to happen, but what happens is our current exit is about 60% into IPOs, and possibly about 15% in strategics or M&A, which will change as the economy grows more and more, you know, investment happens in India. And what will help that is, you know, India is like the Japanese and German, you know, market, where most of the businesses are controlled by family offices. And that goes from, you know, generation to generation, basically. But that is slowly changing because the second or third generation don't want to be in the same business. And they want to sell, starting with non-core to other, you know, sometime, you know, bringing into the core business itself. And above all that, the new age technocrats, they don't mind selling businesses and moving forward and, you know, investing into something else. So and then the corporates in India are also growing. They are also looking for, in addition to their organic growth, acquisition-related growth, and similarly as the economic growth, corporates from from Japan or Europe or US also want, they will look for good companies, they can invest and grow. And companies, when they take private equity money, what happens is the assumption is that corporate governance are being built in, and it could be good opportunities, and they're also in the public domain then. So M&As will, my view is that as we move forward after 5-6 years, the IPO exit will possibly, come down to below 50%, and the M&A exit will increase from the current 14-15% to possibly 20% or thereabout. Secondaries also will pick up because there will be more on opportunities and people will be looking for liquidity. And that as an asset class will gain more momentum. Last point onto the family office, certain family office, they have no DPA pressure. They look for long-term capital growth. They say that if you give us the money, we have to look for other opportunities. The company is going well, and why you want to liquidate now? Whereas certain family offices, they are not receiving cash from the operating business, although they churn the private equity investment activities actually. So there is a pressure of, so different family offices, slightly different way of looking at it. Yeah.
Thank you.
Yeah.
Just to share a statistic, a relevant statistic. I think in the US, I think for the last calendar years of 2025, I think it's estimated somewhere around 15-16% of all distributions from private equity for that year would have been generated through continuation vehicles. So not even just secondaries, a subset, so CVs, as we talk about it. So I think to your point, on public markets becoming a smaller and smaller percentage of exits, that should happen also because as private capital becomes, that part grows, whether through domestic capital or just more interest, again, from foreign investors to bring that capital in, right? That percentage of exits through secondaries, through through non-public routes will only increase as the cost of capital comes down.
No, thank you. I think that was actually my segue to the second part of this discussion was IPOs. We have a fairly bullish IPO market as of now. I think it's been a trend in the last 3-4 years where we've actually seen loss-making companies essentially, or tech companies which have a long-term horizon of profitability getting listed. Subscriptions have been extremely high. There is an appetite not just among institutional investors, but also retail investors to acquire such assets. And this, to my mind, is a little different to what is happening in developed countries where a lot of successful startups are not necessarily looking at IPO as a exit opportunity. I think a couple of things which I think even Ajit had mentioned is that there is a sense of pride once is getting listed. So it is considered to be the ultimate milestone for any company to be listed. Keeping that in mind, and the general trend of how our economy is working, what is your sense? Is this trend going to continue? I think both Ajit and Dominic have kind of mentioned that it's about a 3 to 4 year horizon again. Is that something both Vikram, you and Krishna agree with? How do you see this whole bull trend continuing?
So yeah, I think of course the volume-wise, the number of IPOs will definitely increase. I think proportion-wise, and I agree, maybe percentage-wise, you will see M&As actually taking over in terms of the value and the volume. And I think there is still a challenge in terms of, I think even from the institutional capital perspective. What we've seen is that there are mutual funds on one side and there are other institutional investors. We've seen that given the fact that the number of these institutions is still low, even though they have much deeper pockets, there is also, I mean, we saw that in last year, one point of time, there were about 70 IPOs happening at the same time, all hitting the same set of investors, which are very few investors, and obviously, and they were all talking to each other in terms of asking what should be the price of the IPO. And if that is the case, and if the company going IPO is basically dependent on them, basically they decide the price they want. So effectively, we also saw for a period of time, especially that maybe the price set for the IPO was probably, different from what they originally started with. So I think there was a gap from that perspective, quite substantial gap in certain cases. And I think unless that pocket is deepened further in terms of number of institutional investors, and also the potential size of that capital, people would want to really then explore possibilities, and if they're not getting the best price, they would maybe file for DRHPs, because even the DRHP ratio to the actual filing, you will see a significant drop-off, right? Because people want to try it out, and if they go to the market and then they realize that they're not getting the price they want, they pull out. So I think you will see that happening. You will see a lot of people going for filing their DRHPs. The dropout ratio might actually further increase. So the number of people filing for DRHPs will substantially increase, but the people who are actually filing might come down. The DRHPs give you a lot of visibility in the market. A lot of alternative options come up, right? So once you're visible in the market, a lot of M&A options also come out. So I think, so you will see that kind of a trend emerging. But overall volume, like we said, last 5 years, 375 IPOs, $75 billion. If we extrapolate that over the next 10 years, I think it'll be a multiplier of that number. So the volume and the value-wise will increase quite substantially.
Krishna?
Yeah, I think I agree. The 300-odd IPOs last year, I think also what we see is the main board IPOs doubled.
Correct.
Between 24 and 25, which is maybe good news in some way. But the oversubscription dropped. The number of times you get subscribing, all of you have Gemini, you can check. What I'm saying, it dropped from 44 to 33 or some number like that. So these are data to be taught to. We at AIFs, I think one of the challenges we will face, even in listed stock, is liquidity of the listed stock. So for example, 50, 60, 70, 80% is owned by institutions / funds. Then it's not just, it's listed,
liquid,
but it's not
yeah.
free flowing. I can't just go and offload 2% in the market without crashing the market, right? So that's why you will see some of these listed companies with large fund investment are having a kind of an artificial ceiling, like a circuit breaker set up by them, because the moment it crosses, the fund is offloading 0.1%, 0.2%. You can see that funds are slowly selling and doing that. So listed companies giving equity to the fund is also a bit of a challenge. It's not like it's absolute liquidity. It's only liquidity from a valuation perspective, but it's actually not cash coming in. You've got to be very careful how you sell. So I think that's one challenge that remains. But the good thing, I think for us, as growth funds is, we are helping the companies mature, become adult. Because when they actually get listed, between SEBI and now the new watchdog NAFRA, they make sure that there's a great amount of governance.
Correct.
And therefore, you're actually you're saying actually I have put adults in the market. They're no longer teenage kids who are doing right things some days and wrong things some other days. Right?
Correct.
So that is a big success for, I think, growth and therefore private equity funds to say we have put those adults now in the market. I think that I would say that. But
Fair
listing alone doesn't give full liquidity, right? It's still a bit of a challenge.
I completely agree.
Something there? Please. The challenges post-listing, actually, what happens is everybody thinks, okay, IPO is done. I'm just trying to add on to what Ramoshna says, they can exit. But post-listing is a big challenge to exit, actually, because the market knows that these private equity firm or VC firms, they have to exit. And the price is always, underperforming because everybody knows there is a huge offering going to come. This is a major, because our equity market lacks still depth. We have about 6,800 companies. How many we have? 6,000, 6,500 companies or so, and every day, there is one more listing. But if you see the statistics, like in the US, during the early 2000s, they used to have about 6,600, 700 publicly listed companies, whereas currently it's about 3,800. The reason is obviously, the cost of compliance and the heavy burden on, compliance, and whole lot of private market activities. So if I have to look at a company, and obviously, the first one is, in real estate, we say, location, 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 like that is promoter, promoter, promoter. And second one is exit, exit, exit. So we look at multiple exit opportunities. If the promoter says, okay, we will grow to this level after 4 years, 5 years, we will take the company public, we will see whether it has got, multiple way of exit mechanism, basically. And if there is a M&A related exit mode, we would prefer that. The reason is then you can avoid these kind of uncertainties of exiting through the IPO market. And also, sometimes, the M&A price may be slightly lower than the IPO market price, but you can get the full money up front if you have a clean exit. We recently sold one to Accenture, part of it, and part going to be sold to them again. So what happens is a multiple exit window opportunity in any private equity investment is an ideal situation rather than just depending on IPO market itself. IPO market itself, if you look at the vagaries of the capital market buoyancy, the economic cycle, and it can get prolonged. India had a notorious image of not money coming back. Oh, India, you take the money, it doesn't come back. In fact, one investor went to the extent of saying, why in India founders called promoters? They promote themselves. Because they even go to that level, actually. People didn't get liquidity out of it. But the scenario has changed to the US as well. US has, over 22, 23, 24 has been very, very bad for liquidity. It is all coming out because in the US they had a very, very low interest rate regime. And whether actual exit happened or not, the managers could borrow money from the bank and give money back to investors at dividend recapitalization, get the cash flows of the company, operating companies, and they could borrow money as NAV loans or subscription credit. So people have been getting liquidity. When interest rates started going up, IPOs died up, M&As died up, the DPI has become a major issue. In the old days, when I go to US, people look at, performance, IRR this, TVPI this. Now the first question is, what is your DPI? So to that extent, the DPI has become, more pronounced and more challenging to fund managers, actually. And in India, I think because the interest rate is coming down, and we never had a regulation where we could do leverage mechanism to go for any kind of acquisition in the country. So I think recently there has been some announcement of the acquisition financing by the bank. There are certain conditions. But possibly once that is smoothed out, and the low interest rate regime obviously can be helpful for more and more IPOs happening in the country. So more IPOs, plus we obviously have an active IPO market. More and more money will come out of India.
No, thank you very much. I think just to double down on, I think, the IPO market itself, I think one, of course, I think what we agree as a panel is we're looking at least a good bear run of, at least bull run, sorry, for about 5 years or so. Now, I wanted to touch upon each of you, your experience generally dealing in an IPO. And the reason I ask is that over a period of time, our regulator has actually imposed quite significant obligations, both from a disclosure requirement as well as from a governance requirement on companies getting into IPO. Every year, I think we are getting more and more regulated in terms of disclosures, in terms of misrepresentations and the penalties, all those. We've got NAFRA, which Krishna just mentioned, which is placing quite significant obligations on the directors, the audit committee, which they typically consider as those in charge of governance, as well as statutory auditors. Now, with this level of so-called maturity, as Krishna had put out, the trend which we have actually looked at is that a company which is considering going into IPO perhaps should start this process maybe at least 24 to 36 months in advance of what its intended listing is. How do you guys see this, and how does it work to push the management to get into a governance zone? Because what happens is there is always this debate between the management between growth and governance. There will always be a pushback from the management to create more systems and processes. The management will always prefer for it to be agile. So it does create a bit of friction. So how does that work? I mean, what's your typical experience been, and how have you guys been able to resolve it? I think perhaps if each one of you could spend a couple of minutes on that. Whoever.
Yeah, maybe I can start. So I think, first of all, we are seeing a very interesting trend. Actually, some of our companies which are growing year on year, like doubling every year, and some of them are actually getting to that size where they can start thinking of IPO. Actually, we are seeing this coming from the founders themselves, that actually we think we are getting ready for an IPO. And some of them are, and they're talking about we need 2 to 3 years of preparation, which is actually a very positive sign that they've themselves started working on their processes, systems, getting their house in order. And I think part of this might have happened also because we've seen examples of bad corporate governance which got very highly publicized. And I think some of these founders actually learned from those experiences, right? So, and they saw how you get punished for bad corporate governance. And I think we've generally seen a very positive thinking about getting your house in order, getting your systems in place, getting the right talent at the top. Of course, the regulations have also evolved, and therefore, there is a cost involved, and one has to. There is a trade-off between focusing on growth and then investing in ensuring that you have your right systems, processes. Mature entrepreneurs actually start very early, and I think that maturity levels have increased quite substantially. So that's how we are seeing it today.
I think because we invest a lot in growth, so at the time of growth itself, we do a significant amount of time on management assessment, which is the L1 team of the founders. So in regulated companies, the compliance head or the regulatory head. In other companies, the CFO and the CHRO in addition to the compliance person. I think that being able to work as an yin and yang between the CEO and CFO, I think is a very important ingredient. So that 2-year journey, you have to make sure that the CFO, CHRO is matured, or you replace. You have to take those very tough decisions but those decisions have to be taken in earlier when you've taken public money, there's no doubt, right? Even our money is public money. It's not like it's just one person putting money. It's also a lot of public money. And that yin and yang working is very important. So if you go from a pure corporate governance perspective, the Anglo-Saxon model has just the board, right? The Germanic model has a 2-level board, correct, where the CFO reports to the board independent. So the CEO cannot fire the CFO, and the main board decides the remuneration and the goals of the CFO. So there's a duality in that structure. I don't think we are able to reach that because we are following the Anglo-Saxon model for whatever reason. So therefore, having a very strong CFO or CFO plus CHRO, CRO, that combination is very important. If you put your money on the right person, a professional founder or a promoter, and the person who has eyes on long-term view, I think we are okay because that person will understand. We have had experiences where you told them your CFO is actually a financial controller, not a CFO, get somebody else. They worked on that. Your CHRO is a VP HR and not there. So you're not having that yin and yang conversation with them. So that active board engagement is very important. If you see the new NAFRA thing that's come, those charged with corporate governance, very interesting, bit ambiguous to lawyers and audit firms' delight. I think ambiguity is helpful. But clearly what it says is you need to do a little bit more engagement. You can't do post-event, you have to do pre-event as well. So I think putting all that together, I think we are in the right direction for governance. And I think we are also enjoying those conversations. But I think somewhere there has to be balance. Because sometimes the regulator is enthusiastic and say within 30 minutes, within 6 hours, it needs to be reported for listed companies. I think that's unrealistic in a multi-location, multi-product company. You have to be a little more, and materiality is very low there. So I think some balancing is required. But I'm sure SEBI will do that.
No, I think as I always say, I think bad facts make bad law. So because we've had quite significantly bad corporate governance experiences, I think the regulator has been on the side of caution, but it is evolving. Dominic, I mean, how do you look at it compared to at a global level? Do you also kind of look at where founders are broadly aligned with a 2 to 3 year horizon period, and they are keen on looking at some of the ideas which I think Krishna mentioned of having a separate CFO, the yin and yang, and the Anglo-Saxon model? Is that very similar in global?
Yeah, because, so we're not direct investors ourselves.
That's correct.
So I'm a little bit more removed from, I think, the intricacies of, company level.
Sure.
The do's and don'ts. But I think what I'll say is that as it relates to India and, regulatory reform and all of that, I think the fact that that has been happening at what I would say a consistent pace, I mean, it's not been erratic. That's all right. Over the last few years, I think is a big part of the reason why what I would call, or what was mentioned as maybe unpriceable India risk, where you couldn't even get your DPI out, that has largely gone away. And I think it's a big reason why that foreign or the institutional capital is able to then price India, and why we're seeing then this growth of private markets. Because in public markets, right, it's sentiment that decides, that prices the risk. I think in private markets, it's fundamental analysis of the risk, and that can be done.
I think we have a couple of minutes, and then I'll ask the audience for questions.
All right. So, you see, even in the best regulated market, corporate governance issue can happen actually. So India is no exception. However, with no, offense to VC investors, VC fund managers, the VC managers are more focused on growth, basically, irrespective of whether the company is making profit or not, actually. Whereas the private equity guys come with a, different lens, including corporate governance, profitability, and all that. But after a few, major blow-ups, now everybody wants to get into profitability, everybody wants to get into, more corporate governance, adherence to more corporate governance. That's a good thing for the market, actually. And, it's again differs, if somebody wants to create problem, we can't stop it. And, when you do the diligence, sometimes we have to engage, private guys to do, all kind of investigations on, including the promoters. So all those things we do to limit, and once you are on board, we'll obviously would have listed out what are the lacuna and what needs to be built up, everything we do that. So only thing we only can do to a certain extent. Sometimes, it goes overboard in any market for that matter. But if it's not too many, it's not creating overall problem to most of the investors, it's okay. I think we are fine. One or two blob here and there, it happens everywhere.
Fair enough. I think thank you, everybody. I will leave. I think there's some time for questions from the audience. Please. Can you give a mic?
Thank you. My name is Umakant Panigrahi from Kroll. Interesting session. I want to understand a slightly different facet of LPGP interaction, so to say. Just to give a bit of background, I think all of us, we know that whenever any fund is going for a new fundraise, LPs are getting operation due diligence done. Now, over the last couple of years, as a valuation consultant, I've seen an increased focus on, of course, how the valuation process being managed. To the extent, I think, the ODD vendor will call us, have a detailed interview to understand, how the process is being managed, how data comes, and they will not say asking, okay, do you get influenced by, the fund managers? So question is that, day-to-day interaction, are you also seeing an increased, questioning from LPs with respect to not, okay, what governance happening at the company level, the investing company level, at the fund level? So maybe, some insight will be helpful on that.
See, in our case, we have 28 Indian institutions as our LPs. The banks, we have 12 banks, and we have about 13 insurance companies, and we have the government institutions, and these are very, very detail-oriented when it comes to due diligence. And of course, across all our investments, a lot of data that we have to share with them on an ongoing basis. So for us, I think it's not an option. So we have to be, in fact, that's the reason we've developed a lot of in-house IT systems to collect a lot of data, which actually now gets automated to report to these LPs. So we are seeing lot more increased requirements in terms of data from each of the companies.
You have to strike a balance between what is internal, like in corporate governance, internal governance, doctrine of internal governance, and what they have to do. And I agree with what you're saying. I've had at least 2 or 3 instances where large family offices have asked, in the middle of the fund, 3rd year, 4th year, can I talk to the valuation person, understand why they valued this? I also was very perturbed by this couple of questions, and I said, let me first stall. That's the first thing that comes, right? There's too much of work for me. Why should I do this at all? Is it good governance? I don't know. But then I realized what's also coming out is there are judgment calls being taken by different valuation agencies and different funds because they've come at different points of time and their exit views and their outlook is slightly different. So that the art of the valuation, which is the discounting factor that you all know very well, is where I think, or the comparable factor is sometimes judged very differently. So which is a bit of a challenge. So I think therefore, what comfort we need to give to LPs is, we have a independent valuer, not necessarily somebody who's just approved by SEBI, but of repute, really of repute. And we have a good statutory auditor who's also doing a review of the valuation. Then that comes. So for example, in my LP conference, I had told them our investment team does the valuation, then external valuer does it, then our statutory auditors, in our case it's actually Ernst & Young, they also have a valuation team which does it. So 3 layers of valuation is done. Now if it slips through these cracks and people have a different point of view, I'm happy to listen to it. Right? Happy to listen and take inputs, but we can't keep re-engineering the process. So already like check the checkers, 3 times you have checked the checkers. How many checkers will you put on a checker? So some balancing is required, but where there is concern, I think we should hear, because that gives you an external data point that they are seeing a similar investment being held to a different valuation by some other fund. That was very useful insight.
Fair enough. Which we see more often actually in different funds, the same investment, different valuations. Investor sophistication vary very much actually. Some investors are very much, detailed oriented, and they wanted to get deep dive during the initial diligence period. And also some of them, they even engage, third parties to do back office and operational diligence. That's a good thing for the manager to get standardized the processes and all that. But as long as you follow the valuation methodologies set by authority standard like ILPA or other agencies, and if you provide impairment in time, the general tendency among managers is impairment, they just slow down in recognizing actually. As long as impairment is recognized on time, and you use a conservative valuation mechanism, because many a times you are seeing that, we all engage third-party independent valuer, one of the big 4, but many a times our carrying value is lower than what these guys come up with. So when an investor raises a question how you are carrying this value, we give a copy of the external valuation report. Look, this is what the valuation has come up with third party, because they obviously have their own way of valuing it. So once you establish that credentials, investors are fine. However, increasing scrutiny on valuation and the way the manager operates are happening around the world actually. That will also be happening even in India as well among all these family man. See, now you see these family offices most of them are not that sophisticated. Possibly 10 years down, you will see, much more diligence requirement and, all these, questions, coming out of Indian investors as well.
But I'll just add one more point here. It's a very interesting example. Let's say Krishna and I have invested in the same company, and I've used Deloitte and he used Ernst & Young. We both come with a different valuation of the same company. We have the same LP. Imagine, so we're reporting to the same LP, same company but different valuations.
Correct.
That also happens. So I think it's something that both are cases an independent valuer. They come up with their own independent, different valuation of the same company. So I guess...
Yeah, so because we have a fund of fund component, we see different managers carrying different values of the same asset. Yeah. So
Yeah. So
First of all, very, very wonderful conversation. Thanks a lot. So I just had a further question on the valuation bit, actually. There are different numbers that are possible, right? And one of the things that comes up then when you're looking at exit, right, and especially M&A, you're then looking at the promoter or the founder having a different value in mind, and you might think that, you know, it's the right time to sell, and the founder wants to stay on, right? Obviously, you come across this, and how do you resolve that?
You mean discrepancy between the VC and the founder in terms of
mismatch
the exit,
in terms of expectations.
mismatch in terms of expectations. That can happen definitely. See, that's the reason at the time of investment itself, you need a lot of time with the founder. So we don't just one fine day decide, okay, let's invest in the founder. We spend multiple sessions with the founder. I want to make sure they're comfortable with the fact that we are managing third-party capital, we have an exit time frame, and their exit clauses are negotiated really hard at that time. And one of the exit clauses is the exit can happen through an M&A. And as an example, even if I'm holding just 15% of the company, if the founder is not able to give me an exit in 4 to 5 years, I have a drag clause, which means that I can sell 100% of the company. I have that power if he's not able to give me that exit. The founder knows that because he signed that at the time of our investment in the company. So therefore, when the 4th year is approaching, the founder, if they are already doing very well, and they know that my exit time frame is coming, so they will find another investor to buy out my stake if I'm not able to find an exit for myself. There will be some differences at that time, there could be, and all those are factored in at the time of the investment itself. So it's a process. We're sitting on the board of the company, and of course, even over a period of time, we are aligning with the founder. By the time we're in the 3rd year, if you know that the 4th, 5th year is the exit time frame, we start discussing at that time itself, so that it's not a one fine day we say, hey, we have to sell our stake now what do we do?
We are very well protected by colleagues like him, his partners right now doing a very interesting protection for us where it is. But end of the day, those documents that we write, the rights, sit in the drawer, because then we build friendship and we build joint, because we have a fiduciary responsibility as a shareholder and board member. We have to make sure that company is successful. Company and founder cannot get impaired because of our exit. So that balance we need to strike, because end of the day, you're creating value, and so many people's money is gone in, right? You're creating value there. So our exit should not trigger what you call negative value for them. So we have to solve. So sometimes it gets very tricky, and that's why those exits get more complex. And we work on it together, because end of the day, what you leave behind after exit has to be equally valuable for someone else to buy, right? Because you're selling it to somebody else, and that person has to find value to hold on for another few years. Yeah.
I think just to add to that, one of the things which we do in our documentation is to preempt that. And you could have, let's say, the founder appointing one valuer and the investor appointing another valuer, and perhaps then doing a average matrix of that as well. So there are various ways in which, from a documentation point of view, one can do that. And I think, as Krishna said, all of these documents are put in the shelf. The day you have to open the document means things have gone wrong. Any other questions?
One last question.
Okay. Hi, I'm Anish. So firstly, thanks a lot for this session, very interesting. I have 3 questions, and I'll put it all, right up, since it's the last question, or last chance. So the first thing is for Dominic, and Dominic, you also discussed about, pricing risk. And, one is obviously you go at multiples and, try and figure out the valuations, etc. The other is the fundamental way, which, starts from your risk-free. So how are you looking at risk-free now, since, most of the times risk-free used to be the US risk-free rate, which now is all over the place. So I think that was the first question, and I'll just ask the other 2. Vikram, for you, obviously you're part of the India Deep Tech Alliance, and that's a phenomenal thing. We spoke about exits, and obviously deep tech is one situation where it takes a lot of time in terms of building the product, given it's, in a lot of times, it's also research intensive. So are we looking just to depend upon the RDI fund, or how are we looking to invest into deep tech? This third, anyone can kind of answer. As investors, obviously we've been investing into companies, there are these founders, some companies work, some companies don't. The ones which work, in how many cases, I mean, just a ballpark approximate, those founders then come back and invest into us as LPs in our next fund. So, yeah, sorry, thanks.
All right. I guess there's a question on risk-free rate. Fundamentally, that's not how we use or what we look at when we think about pricing risk. If I understand your question correctly, how do we price risk? And the reason why we don't use the risk-free rate, I think, as you had alluded to, it's kind of all over the place, and it's a little bit of an academic thing. The way we price risk is, and it's all relative because as a global investor ourselves, right? When we bring an Indian secondary to the IC, or we bring China, we bring whatever, any opportunity, right? We look at it on a relative basis, right? We compare everything together. It meets everything. You're kind of solving for a level of returns that's commensurate to the relative risk of each opportunity, right? And so when we then think about, all right, what is the right target returns for, you know, a portfolio of high-quality US buyout funds versus something in India, which is maybe more concentrated, maybe it's a single asset CV, et cetera, et cetera. And so that's how we then, I guess, calibrate what that level of return, i.e. what are we pricing the risk at, right? And we think that that's also the right way to do it, because at the end of the day, our LPs, they don't have a risk-free rate in mind as well that moves all over the place. They don't think about it that way, right? They look at our funds, our strategy, right? And to them, they think that, all right, a particular strategy, whether it's secondaries, whether it's co-investments, should generate X amount of returns in the current environment, right? And so we go from there. It's all relative to that sort of benchmark.
Sure. So fundamentally, you wouldn't look at it from a different market perspective when you're looking at an entire allocation, say a developed versus an emerging market, and say that maybe at you know, an emerging market situation, you may want a certain amount of risk premium over your overall portfolio, which may be a lot of depth.
So we would I guess you know, whether it's India or any other market, I think at DIC, it's always a discussion around, all right, is it, you know, what do we think about the FX? Are we, you know, who is the manager that we're backing? Is this a top quality manager? So it's not so, what's the word to use? It's not as if there's a grid that says, okay, this country is in that box there, and so therefore we add 50 basis. It is actually a lot more, it's a lot more gray in that sense, right? Because there's so many levels of, or types of risk in an opportunity at the secondary level, because bear in mind, we're not just looking at one company, we're not direct investors ourselves. We need to think about alignment at the GP level, we need to think of, right, portfolio concentration, which sectors, which vintages, et cetera, and so it becomes a lot more tenuous in the way that we think about how to price that risk. Yeah.
On your second question, I think you're right. Deep tech, of course, is very high risk right now. And that's the reason you also need a lot of government participation, and that's the reason we've seen the RDI fund coming to support that, and especially because most of the deep tech innovation is still happening at very early TRL stages. I think the good news is that this $11 billion that they have allocated, and I think they're moving very fast to allocate to the funds. In fact, I'm seeing a lot more new funds getting created only for deep tech now. I can see my friend here, Vishwesh from Special here. They are actually pioneers in just focusing only on deep tech. And I think you'll see a lot more of that happening, more and more deep tech specialist funds. And from an exit perspective, you would see, obviously, this will evolve over time. And I think if you're taking bets at, let's say, TRL 5, 6, 7 levels, you will see once it goes to the market, obviously the value would evolve, and there will be funds who would be willing to give exits at that point. So I think we're still in that early evolution stage, but the fact that the government is willing to come and participate with such large capital is very positive sign.
Essentially, if there has been an exit by a founder, how likely are they to be
But by the way, that's already happening. I mean, you see a lot of these founders, you've seen Titan Capital, ex-Snapdeal founders, and you see a lot of other, all these people sitting on Shark Tank are all ex-founders, right? So they're writing checks every day there. So I think it's a good thing again. They don't only bring the capital, they also bring experience of taking companies from zero to IPO.
Not only on the exit side.
They invest back in the same fund or? Yeah, so the same fund. We had some experience, many of them have, but we cautiously take a very small amount because, you know, there's no round tipping in this, but, you know, to be above par, it's always better to take a small amount that's a fraction of his portfolio or her portfolio and a fraction of our fund. So that keeps you, you know, above water. Yeah.
See, as long as there is no conflict, you have fully exited, and if he's investing, you can look at it. There's no conflict at all. However, you know, not only investing into it, there are, you know, like founders with whom we have invested in the past and exited fully. And he also exited, he sold the company to somebody else. They bring in more opportunities, actually. That's becoming another, you know, set of opportunities for VCs and private equity investors, actually. I mean, it's quite common, actually. No, it's happening. It's happening actually, but may not be, you know, too many of them. But some of them are investing because they look at not only in this particular fund. That's maybe because of the relationship understanding of the portfolio and their investment thesis, but also they look at investing in other opportunities as well. You know, many of these founders are angel investors in many opportunities actually. So these are all the overall part of the evolution of the PEVC investing landscape.
And it also depends on the size of the exit for them. So I think some of our founders fully exited and they invested in a fund as well.
I think it's time for us to wrap up. Thank you, everybody. Thank you so much, the audience, for listening to us patiently. I hope it was an insightful session.
Thank you so much. Thank you to all the panelists here. I'll now request all the panelists to please come forward for a group photo. Meanwhile, the next session will focus on venture capital with a special focus on deep tech. Please be back here by 11:30 after having some coffee and tea.